Transfer of assets and liabilities within a qualifying group for UAE corporate tax relief. Overview of transfers between closely related businesses. It is common for closely related businesses to transfer assets and liabilities between each other for operational purposes. Typically, such transfers would result in a taxable gain or loss if the transfer occurs at a value different from the net book value of the asset or liability. However, the UAE corporate tax regime provides relief for transfers of assets and liabilities within a qualifying group, allowing such transfers without incurring a corporate tax liability. Qualifying group membership conditions. To be treated as members of the same qualifying group, taxable persons must meet the following criteria. 1. Residency status. Both taxable persons must be juridical persons that are either resident persons or non-resident persons with a permanent establishment in the UAE. 2. Ownership threshold. Either taxable person must have a direct or indirect ownership interest of at least 75% in the other, or a third person must have a direct or indirect ownership interest of at least 75% in both taxable persons. 3. Exclusions. None of the persons should be classified as an exempt person. None of the persons should qualify as a qualifying free zone person. 4. Financial year alignment. The financial year for all taxable persons must end on the same date. 5. Consistent accounting standards. All taxable persons must prepare their financial statements using the same accounting standards. Tax treatment for transfers within a qualifying group. When an election is made to apply the transfer provisions within a qualifying group, assets or liabilities that are transferred between members are treated as being transferred at their net book value. This ensures that no taxable gain or loss arises from the transfer. The key tax treatment principles include: the amount paid or received for the transfer will be treated as equal to the value recorded by the transferor for the asset or liability. Taxable income calculation: for the transferee, any depreciation, amortization, or change in value of the transferred asset or liability is disregarded for tax purposes as long as it relates to the gain or loss that was deferred for the transferor due to the relief. Upon realization of the asset or liability, such as when it is sold or transferred to a third party, the transferee must include any previously unrecognized amounts for corporate tax purposes, except for amounts arising before the most recent transfer where relief did not apply. Conditions for making an election. To apply this treatment, the transferor must make an election alongside their tax return for the tax period in which the transfer occurs. Both the transferor and transferee must keep records of their agreement to transfer the asset or liability at its net book value. This election is irrevocable and applies to all future transfers of assets and liabilities held on capital account within the qualifying group. Clawback provisions for transfers. The relief may be clawed back if the asset or liability is subsequently transferred outside of the qualifying group within 2 years of the original transfer. Either the transferor or transferee ceases to be a member of the same qualifying group within 2 years of the transfer. In such cases, the transferor must treat the original transfer as if it occurred at market value on the original transfer date and account for any resulting gain or loss in the tax return for the tax period when the subsequent transfer took place. If the transferor no longer exists, the transferee is responsible for any corporate tax obligations on the deferred gain or loss. Examples of qualifying group transfers. Example 29. Relief for transfers within a qualifying group. Scenario: C LLC and D LLC are manufacturing businesses fully owned by X LLC. Both companies meet all criteria to be considered members of a qualifying group. Operational need: during the tax period, D LLC secured a large contract but required specialist machinery for production. C LLC owned such machinery but no longer needed it. Therefore, C LLC transferred the machinery to D LLC without any payment. Valuation. The machinery's net book value at the time of transfer was AED 800,000, while its market value was AED 1,200,000. D LLC, using the fair value accounting method, recorded the machinery at AED 1,200,000. Tax treatment. For corporate tax purposes, the machinery is treated as having been transferred at its net book value of AED 800,000. As a result, no gain or loss arises for C LLC. When calculating taxable income, C LLC is considered to have received AED 800,000, and D LLC is deemed to have paid AED 800,000. Example 30. Subsequent transfer. Scenario. After 1 year, D LLC no longer needed the specialist machinery due to the loss of its large contract. It sold the machinery to a third party for AED 1,500,000. Clawback of relief. Since the asset was transferred outside of the qualifying group within 2 years, the relief no longer applies. As such, C LLC, the original transferor, must treat its transfer to D LLC as occurring at the market value at the transfer date, resulting in a gain of AED 400,000, AED 1,200,000, AED 800,000 in the tax return for the tax period in which D LLC sold the asset. Transferee tax treatment. Since the original gain has been taxed for C LLC, it does not need to be accounted for by D LLC. For tax purposes, D LLC's taxable gain is AED 300,000, AED 1,500,000, AED 1,200,000, following its accounting treatment.